Welcome to Easy Accounting From. We have completed the first half of this basic accounting course, and with this video we are starting the second half. I hope the concepts we have covered are making more sense, and as we move forward, everything will start to come together so you can see the full picture of the accounting cycle. But before we dive in, I appreciate you to subscribe and hit the bell. I'll be posting more accounting videos with topics like inventory, depreciation, amortization, fixed asset reconciliation, and much more to help you build additional knowledge and skills in accounting. Thanks again, and let's keep learning. This is the video number 3 of 4. So, in my previous video, I explained the following topics. Video number 1, we talk about what is accounting, the accounting cycle, the accounting equation, type of account, and natural first account. Video number 2, we were talking about source document transactions, source document essential details, organize and classify the source document from the transactions, the accounts, debits and credits, journal entries and general journal entries, general ledger, record transactions. In this video, I'm going to talk about chart of accounts, type of chart of accounts. Also, we are going to start a complete exercise to go through the entire accounting cycle, and it will be the time to apply all the key concepts we have been learning. Our example company will be in a mixed industry that provides service and also sells automobile parts or auto parts. We will name the company for our practical accounting process. We will create a chart of accounts for these businesses. There will be a list of transactions to be processed during our practical exercise. So let's do it. Chart of accounts. What is a chart of accounts? A chart of account is an organized list of all accounts a business uses to record its financial transaction. Each account represents a specific category such as assets, liabilities, income, expenses, etc. The chart of accounts can be formatted in two main ways. The first one is a simple list of accounts with names. And the second one is a numerical list where each account has a designated number and name for each classification and reference. We are going to use the second one. The purpose of the chart of accounts: categorize transactions in appropriate groups: assets, liabilities, equity, revenue, expenses, income, etc. Support the preparation of financial statements in clear, accurate, and logical format. Ensure consistency and organization in financial reporting across periods. When using a numerical format, accounts are typically structured as follows. Number 1, all the accounts that start with number 1, it is for assets. Number 2 for liabilities. Number 3 for equity. Number 4 for revenue or income. Number 5 for cost of goods sold or cost of service. Number 6 for expenses. So if you notice, in each group you can just create we can create 1,000 accounts. So this is the standardized form, and every organization, every industry has their own regulations. So sometimes the chart of account has to be created for those regulations. Type of chart of accounts. The type of chart of accounts usually align with a specific industry, as each one uses its own terminology and structure. For example, construction companies, aerospace companies, service businesses, non-profit organizations, government agencies, and manufacturing industries. Each industry has to follow their own regulations. Our company name is going to be Auto Maintenance and Parts A&P. So welcome to our company exercise for auto maintenance and parts A&P. This is a fictitious company that offers two main services: vehicle maintenance and repairs, and selling cars, parts, or auto parts to customers. In this exercise, we'll guide you to step by step through the full accounting cycle. You will see how to record transactions for service and parts sold, track business costs, prepare financial statements, and this practice activity will help you to understand how different types of business transactions use accounting to keep the financial records organized and accurate. We will use the accounting accrual method. Remember that we spoke about three types: cash basis, accrual basis, and hybrid. Let's dive in and explore the accounting world for our maintenance and parts, which is our company. The chart of accounts. Keep in mind, most business owners start running their business without a proper accounting system or even a basic chart of accounts. By learning how to set things up the right way, you will be able to organize the accounting process, not just for your own business, but also if you are working as a bookkeeper or accountant for others. We will create and use the chart of accounts for the business operation of auto maintenance and parts A&P. The company will apply the accrual method that we already mentioned before. Through the exercise, I will explain in detail some other concepts related to the accounts involved. So the chart of account. So remember, number one is for assets, so I create these accounts. And these accounts or this chart of account is created just specific for this auto maintenance and parts A&P. The chart of account can be longer and complex as needed according with the company. But in this case, we have just assets, cash, banks, account receivables, inventory, prepaid expenses, tools and equipment, furniture, and accumulated depreciation. That's the group account for assets. For liabilities, accounts payables, payable liabilities, Visa card, and that's the account that I create for liabilities that we're going to use. It could be hundreds of accounts, okay? Owner's equity. In owner's equity, I create just owner's capital, owner's withdrawal, retained earnings, and profit and loss, or profit or loss. Okay, these accounts belong to the balance sheet. But I want just to draw your attention. If you see the gap that we have between 10, 15, 20, 30, 40, 50, 55, 60, well, this is because in that way you can create other accounts in between. So remember that each group has the capacity to have almost 1,000 accounts. So that's why we create the gaps, just to create at the beginning certain levels or certain accounts that we needed. So let's move to the chart of accounts for revenue. Remember, revenue starts with number 4, so let's start revenue. And we have two types of revenue. So we have the service maintenance, and we have the other part that we sell. Okay. Also, we have create another account that is sales returns and allowance. So this is when people we sell some parts and the customer came back and returned the parts. It's a good idea to have this account just to track the volume of the tools that we have. Cost of goods sold, I start just using this account. I start with number 5. So I have just one item, which is the cost. We are going to track in the cost for auto parts. And we have number 6, that is operation expenses. So we have salaries and wages, utility expenses, supplies expenses, depreciation expenses, repairs and maintenance expenses, insurance expenses, bank fees, communications, business licenses, and all these accounts in this part of the chart of account are belong to the income statement or profit and loss. So you put together all your the balance sheet accounts and the P&L or income statement accounts. So the chart of account, it looks like a list, like this, and that's the way that looks in any system, right? Obviously this is very short, but again it could be dozens of accounts. Well, from this point we are going to start doing the exercise. So it's going to take a little longer to do that, but it's very important to follow transaction by transaction until we finish. So the exercise is going to be presented in Excel because I want you to see how the thing moves around. So let's move to Excel. Okay, here we are with Excel. So this size represents the transactions for 1 month for auto maintenance and parts. As I say, each transaction usually came from the source document. So the source document is a physical document or electronic document. So please assume that every single thing that I just wrote here, it is a source document, and let's start. So the other side of this one, I just create using the chart of accounts and the transaction. I just create these journal entries. We are going to fill it out with dollar amount because what I want is just to explain how that happened, but I don't want to start just doing it from scratch because it's going to keep a lot of time. Bookkeeping is one of the most consumed time that we have in accounting. It is very demanding in time. So let's start. We have several transactions. Let's start with the first one. August 1st, owners invest $50,000 in cash into AMP to start the business. They provide, please assume this is the check number 1001. So we have to put that money when you guys put the money, you have a product in your pocket, on your desk, on your safe. So that's the cash. That's a cash account. So we put 50,000 debit in cash because you have it there. Okay. And the other one is the reason why you put it there is because it's capital investment. So we put it create capital investments. So it's important to reflect from now on that the assets accounts increase with debits and the owner's capital or owner's equity increase with credits. Keep in mind those things. Okay, the second transaction is say that in August 1st we open a business checking account. Okay, we open a just to open the checking account is by themselves, but at the same time that came together with number 2.1 that say that we deposit the 50,000 and we create the deposit 001. So we know that the money was in cash. So now we are going to move that cash to the bank account. So what we are going to do is we are going to increase our bank account. So we are going to type in here 50,000, okay, because we deposit our in our bank. So we are going to use the cash, take the money from the cash, okay, which is credit. Okay, so we have already moved the money from the cash into the bank. So I would like just to refresh. Here we have one assets account and one owner's equity account. And here we have two assets account. So in other words, we haven't received any income yet. So this next operation is the company pay rent for 2,400 using check 101. So we have rent expenses, check 101, and we can just type any description that makes sense, that explains the reason of that transaction. So we are going to just type here 2,400 as a debit, because remember expenses account natural is a debit account. Most of the transactions are debit, increase with debits and decrease with credits if it's necessary. And we're going to take the money from the bank, not from the cash, because cash is already zero balance. But we're going to take the money from the bank, so this 2,400. Okay, so let me save this one here. So let me go to number 4. Number 4 is a purchase office furniture. The company purchase office furniture, which is deck, chairs printed for 3,500 with check 102. Okay, we have check 102 as a document. We just type any description that makes sense. In this case, I just type deck, check printed. Okay. So we are going to just remember this is a debit account because it's a furniture, and the furniture in this time has to increase, and the increase for the assets accounts is using the debit account, debit side for the T account. So we say that we purchase the one for 3,500. We have 3,500 here, and the money came out from the bank. So that means we have been reducing our bank balance. So, and it's an asset account, and the asset account, okay, that is reducing with credits. Okay. So let's go to number 5. August 3rd, company paid 1,200 for business license and permits to cover 12 months. It is very important to pay attention to the cover 12 months. If that means we are going to pay ahead of time certain money that is going to cover future periods. So let's, in that case, we say that it's going to be considered a prepaid expenses, right? So prepaid expenses, we already prepay in advance. That's what the prepaid means. So it's that you did in advance. So we use a check 103. We just type some description that says that this is for 12 months business license, and we can just put an invoice number. It is very important to understand here that this is a general journal entry that I'm using for the full operations, because we are not using a computerized accounting systems. But usually the software, the accounting software, they already have set up journal entries for banking, account receivables, billing, checking. So in this case, because again we are not using accounting systems, we are going to do everything in one general journal entry. So anyway, the prepaid expenses is going to be 1,200, and the money came out from the bank for the checking account, another 1,200. Remember that always we have to keep our journal entries in balance. Okay, debits and credits should be the same total at the end. So in that way we keep the transactions on balance. So let's continue with number 6. Company purchased tools and mechanic equipment for $8,000 and pay with check 104. So we are going to use the account that we created, that is 1050 tools and equipment, check 104. We can just type the information that you needed here, It has to be anything that makes sense, okay? You have to type anything that makes sense for you to understand later on, especially when the time passes, like 2 months, 3 months, 1 year later, you need to find out quickly the information and the answers. So if you have a computerized system, the information is going to jump there in your screen with all the things that you don't need to go to back to find, to look for the hard copy. So we say that here is $8,000. Okay, it's a debit account because it's a fixed assets account, so we have to increase with debits, but at the same time our checking account continues decreasing and we decrease with credits. Okay, let me save this one here, and now let's continue with number 7. It says that the company bought initial inventory of auto parts. So when they say initial inventory, that means our beginning balance in that account was 0 because we don't have nothing. So let's continue with this. They say that we purchased 20 brake pads at $50, 10 oil filters at 15 each, 5 alternators 120 each, 50 spark plugs at $8 each. The total for this purchase is $2,150. So we can just type all the information here. Again, there is usually the computerized system, they have their own module to track inventory, so probably you need to just type a few things here, not necessarily everything, but if for exercise purpose, I'm going to type everything. So we say that we pay $2,150 to increase our inventory, and they say, and it's very important, that this is on account net 30. When they say on account net 30, that means that we don't have to pay right away at the time that we receive the inventory or the parts. We have 30 days to pay. To recognize that liability, we use accounts payables account. So we have to put in accounts payables, and remember the liabilities increase with credits. So we are going to increase our liability right now in 2,150. So let me save this one more time here and move to transaction number 8. Now I want to back a little bit. Remember, we say 20 brakes at 50 each, 10 oil filters at 15 each, 5 alternators at 120 each, and 50 spark plugs at $8 each. I want you to keep in mind that we are going to use this information later on when we sell or when we use one of these parts. Okay, let's go to number 8. I'm going to move this one to the top. Okay, number 8. It says that a company purchased 200 quarters of oil, motor oil, at $3.50 each quarter. So the total is $700. So this is part of the inventory. We purchase oil to sell that oil. So we say the inventory is going to increase in $700, and we pay with check 105. So that means we still continue to reducing our balance in our bank, and remember the assets account increase with debit and decrease with credit. So we are going to decrease our bank balance in $700. So let's move to 9. It says that on August 5th, the company hired one mechanic and agreed to pay $20 per hour, and the mechanic is going to be full-time because he's going to work 40 hours per week, and the type of payroll is bi-weekly. So I'm going to create separate videos, as I said before, for inventory, for payroll, for everything, and we're going to go in deep when this how this works, inventories and payroll. But in the meantime, we don't have to do nothing here. Now, if you have been in charge for HR, so you have to set up this employee in the payroll system, because at some point you need to pay him, and when you pay him, that's going to be reflected here with the journal entries. So we don't have to do nothing in number 9 so far in accounting here, but we are going to move to August 6. It says that the purchase, the company purchased a computer and printer online and paid with Visa credit card. So let's see, we are somewhere here. So we say that we purchase equipment, because that's what it is, computers and equipment, printers. So we pay with credit card. I just put the credit card number is 2015, like a document, one desktop and one printer. And we say that we pay $2,500 for those items. So for that equipment, $2,500, and here we have $2,500. Okay, remember that if you don't pay right away with your cash, if you pay with cash, you reduce the bank balance. But if not, what you're going to do is just to increase your liability. That means something that you have to pay at some point. Okay, I'm going to save here this one a little bit. I'm going to push this up. And let's continue. So we are in number 9.1. Let's go to number 10. Number 10, what is this? It says that the company performed oil change for customer. I used 5 quarts of oil, and they charge $60 cash. So the customer paid right away after we provide the service. So that means that we receive the money and we put it in cash. Why cash and why don't bank? Okay, I assume at this point that they give you a check, for example. You are not advanced in electronic payments, nothing like that. So you just receive check or receive cash. So you put in cash because you have it in your hands. You have it in your office, in your company, not in the bank yet. So I want to clear up that. Now, this is the time to explain that if the person just pay with a debit card or credit card or with any other electronic type of payment, when your money goes straight to the bank, obviously we are not going to use cash. We are going to probably record that one, or the computer is probably raised out that each time that you receive payments in that type of payments, so that money goes straight to bank. But in this case, for our exercise, we assume that they pay cash or with a check. So they pay $60. So we have in cash $60, and we receive that money because we provide a service. So we have some income here, probably the first income in our company or revenue for $60. But at the same time, I want you to keep in mind that when you do this, you have already set up or things about that you sell the part. And in this time, you say you use 5 quarters of oil. So we say that the quarter of oil, each quarter of oil is, we purchase for $3.50. So that's our cost. 350 multiplied by 5, 3.50 multiplied by 5 is 1750. Okay? So we had to start to recognize that we already spent that part of our inventory, and the cost of that part that we already used, it was $17.50 in dollar amounts. I'm going to create a new video related to inventories. So it's a very interesting subject. So at the same time, we had to reduce the inventory because we already just used 5 quarters of oil. So we are no longer had the quarter that we already originally paid for. So we had to decrease our inventory parts in 1750. Okay, remember, let's see this transaction that is a single journal entry. If you remember in one of my videos when I explained about journal entries, I said that it's a single journal entry, and if we say that it's more than 2 transactions or 2 lines in journal entries, it is called a compound journal entry. So we have 4 accounts here. So we have a single journal entry, and we have a compound already, a compound journal entry, that is 4. Now, I would like to say that when you do general journal entries, it is not limit for the volume of transaction that you can put in a journal entry. You can put 100,000 journal entries in one journal and one general journal entry. It's no limitations. Okay, let's continue with number 11. Let's see what number 11 says. It says that we replace a brake pad and we use 2 brake pads. Okay, perfect. So also they say that the customer, we charge 250, but the customer pay 150 in cash, and they pay, or we give them $100 credit. So in other words, we just provide them a certain period of time to pay us the $100. Okay. So what we have here is, either way we sell everything for 250, we just receive right away in cash 150. So we're going to say that this is a cash. We have certain invoice, which I just considered it was my first invoice for the 20001, 20002 is the other invoice that I create for this exercise to make sure that we have always a document. So and I put the description, a place to break pads. So, but we receive just 150 in cash. So the other part, we are going to charge our account receivable because at some point we had to collect the amount, and that's it, right, that we had to receive that amount at some point. So we put just here $100 because 100 plus 150 is 250. Now, where this money or these slides, this access coming from, the 100, the 250, it came from the vehicle maintenance, the service maintenance. So we know that we just provided service for 250. So at this point we have a compound journal entry, but still we have to continue to do things. We say that we use 2 brake pads, and also we say that each brake pad costs us, or we pay for those brake pads $50 each. So if we use 2, that means we had 2 brake pads times 50 equals $100. That's the cost, that's how much our parts cost us when we pay for that one, or we purchase this one. So we had to reduce the inventory for another $100. And look here, we have 1, 2, 3, 4, 5 accounts. So we have in one transaction 5 accounts, so this is a compound journal entry. Okay, let's continue with number 12. It say in August 8 they perform engine diagnostic. So this is just a labor. We don't use any inventory, we just use our time, mechanic time, and the mechanic time is going to be our cost, but this is going to be reflected through payroll. So we just perform a diagnostic and we charge $160. Okay, so we don't see that in cash, and the reason why we don't see the 160 is because we performs a service that was just to do a diagnostic. 160 because it's a revenue, it's an income. So I'm going to move this one a little bit to the top. Okay, I'm going to save here this one. And let's move to number 13. Let me move this one too. Number 13 say that we sold, or the company sold, one alternator for $350. So let's see. We saw one alternator and we just did it for $350, all on credit. All on credit, that means we provide some time to that person to pay us. So if that's the case, we're not going to receive any cash, but we have to recognize that we have the right to collect that money, and the way to do that is just to use the account receivables account. So we say we just create an invoice, the 2004, and we say there is one alternator, right? So we sold that one for $350. So we charge our account receivable with $350, and the reason why we can charge that one is because we sold an alternator. So that's a revenue, that's a parts revenue. So we charge $350. But again, we know that we just take that part from our inventory. So we had to recognize the cost of the part, okay, and also discharge that part from our inventory. So the cost of that part, we say that each alternator was $120. So we say 120, okay, debit, and we reduce our inventory part for 120. Okay, so far so good. Let's move to number 14. August 10, we change oil and replace an oil filter. So we use 5 quarts of oil and one filter, one oil filter, and we charge $90. So let's move with this. Yeah, we already went through several times with these things. So we receive $90 in cash, and that was because we provide the oil change for $90. Okay. So also we have to recognize that we use our inventory. We use 5 quarts of oil, yeah, which is $17.50, and we use one filter, which is $15 cost. So it's $32.50. $17.50 plus 15, $17.50 plus 15 is $32.50. I'm sorry, it's just a mistake here. Equal 17. One second, $17.50 plus 15, $32.50. So that's our cost, and we had to reduce our inventory because we use oil and we use one filter in $32.50. Okay, so let's move to number 15. On August 11, we pay, or the company paid $300 for electricity. Electricity usually is classified under the utilities expenses, which is an expense. So we just type one invoice here if it's necessary. We have an invoice, probably we can just put the invoice number, I did it. and also we can in advance just put a check number. So we say that this utility is for the month of August, and we pay $300. So it's an expense, $300, and we pay using a checking account $300. So let's move to number 16. On August 11, we purchase cleaning supplies. So we say cleaners, we have supplies expenses, invoice number, cleaning supplies. So we pay for those cleaning supplies $250 in cash, but it means we check. So we use a check 107 $250. So let's move to number 17. I just try to move quickly because I already explained enough about these things. I just want to figure out this with you guys, but it's the same concept that repeats again and again. At least the concept, okay? The concept. The concept about what account, how assets account increase, how liability accounts increase, the expenses account, the cost of goods sold. So we already went a little bit enough about that. So let me move a little bit quick here with these things. And please follow me. Prepare, we say number 17, right? We already 16, number 17. Let me move this one to the top. Number 17, in August 12th, pay liability business insurance for 12 months. Okay, that means we purchase a liability insurance, right? That is necessary in all the businesses to have liability insurance in case that somebody get an accident in our facility. So, because we pay liability for 12 months, this is another prepaid expenses. It's a 12 months. So we pay ahead of time $600 for 12 months. So we are in August, so that means that it's going to cover until July next year. So we just use an invoice that they provide to us, invoice number, with that this policy descriptions, etc. So we pay $600 and we pay with a check. $600. Sometimes we say check, or sometimes we say that we pay with cash, but the cash usually companies use the checking account to do that. So let's do number 18. August 12th, pay for internet and phone services. Internet and phone service can be considered communications. So we put the invoice number, the company name that we pay to receive the payment, and we say that is $120, okay, that we pay with check number 110, $120, okay. So let's go to number 19. 19, where's my 19 here? Okay, August 22, we sold 3 alternators for $650 on account 30 days term. That means the person has 30 days to pay us. They can take the alternator right now, but they're going to pay later in 30 days. So that means we need to use account receivables. So we have account receivable here, invoice number, we pay to Franco Pass, we can just put any information, additional information that makes sense. So we say that we charge $650. So the reason why we have to charge $650 is because we just sold to him parts. So we are going to use a sale revenue out of parts. So another $650. Great. Okay, but right now, everybody keep in mind that you have a cost for those parts and you have to reduce your inventory. That's clear already. So we know that the alternative was 120 each. So we say that our cost is going to be equal $3,000 times 120, $360, right? So our inventory has to decrease in the same dollar amount, 360. Okay, let's move a little bit here. So let's go to number 20. In number 20, which is here, it says that August 26, we collect $300 from previous customer. Okay, let's assume that this customer, Franco Paz, paid $300. So what we have to do here, we receive $300, we put in here, debit to cash, and we reduce the account receivable because he already paid $300, so we have to reduce the $300. Remember, this is both are assets accounts. One is going to increase, the cash is going to increase, we will put money in, but at the same time, the account receivable is going to be reduced because the customer paid. So he is no longer owed that $300. So number 21 is say total bank fees for August 31st. Okay, usually every month we receive the bank statement, or we can go online to see our bank activity, and we notice that there is a bank fees, and in this case it was $35. So we are going to just charge our expenses account, that is bank fees, for the month of August, account analysis, that's the description probably, for $35. So where the money came out is from the bank account, $35. Okay, number 22, on August 31, we pay employee for the first 2 weeks 80 hours, so for $1,600. And the company also calculates that there is a tax the company is going to pay for $122. So what happened here is, there is assumptions here. This for this exercise purpose, I got to pay $1,600 to that person. I got to assume that we have $122 expenses, but there is going to be another video, separate video related with payroll and how we record payroll in our books. But at this point, we are going to make it simple. I will get to say that we pay the salary to that employee. We check the 101, 109. We pay 80 hours and 20, which is $1,600. Debit because it's an expense. We take the money from the bank. It's around $1,600. Okay. So also we say that there is a payroll tax for $122, which is an additional expense that the company has to pay for, and it has to be calculated, and not necessarily by the time that we pay the employee. We already paid the money, so we are going to leave it as payroll liabilities. In other words, we are going to accrue that one. So we say that it's part of the check. I just put this check here as a reference, just to tie the payroll payment with the payroll taxes. I just put as a reference there. So we say that employee generate $122 of payroll expenses for the company. So, but we haven't paid, so we have to recognize the liability for $122. And later we are going to pay another time. Okay, let's move to number 23. August 31, all owners withdrew $1,000. So one of the owners say, okay, I need $1,000 from my capital investment. So when they say that, they can just take money from that. It's not a good practice, but it happens sometimes. Okay, so let's do number 23. August 31st, only withdraw $1,000. So we say $1,000 because capital is a credit account, but increase with credit, decrease with debit. So let's put $1,000 here. Okay, and the money came out from the bank, $1,000 here. Okay. So let's do number 24. I was 31. Deposit card received during the month. Okay, based on the calculation that I did, we has been receiving and put money in the cash account for 760. So we are going to transfer that amount or deposit that amount to inside the bank, right, in our checking account. So we are going to make a deposit. So that means the bank is going to increase in 760 and our cash is going to decrease in 760. If you remember in our exercise, we had the beginning 50,000 in cash that we deposit, so the cash was zero. We received certain amount, 760 during the whole process, operations, goes 760, and now we deposit that money into the bank. As a good practice, it is very important to deposit at least every following day the money that we receive. Some companies probably just do 2-3 times per week, but the best policy is just to do it every single day to deposit the money received in previous days. Okay, so now we finish with that, but I just want to do some adjustments. So if you remember, we purchased fixed assets. So I calculate depreciation. And I'm going to have just a video dedicated to depreciation, how to calculate depreciation, the life of fixed assets, etc. But at this point, for exercise purpose, I say that the furniture has a depreciation of $59. So we can just put $59 here. Okay, and always depreciation, the expenses is the one that we start with the 6, we depreciate, but we have to use the other one is just called accumulated depreciation, that is part of the fixed assets. So we're going to credit, because it's the only account in assets that has that increase with credits. So we're going to put the $29. Same way we are going to do with the tools and equipments. I calculate 112, so let's put 112 here as an expenses, and also accumulate depreciation here, 112. This is part of the adjustment that most of the time people just we do at the end of the month. But also we know that we pay liability, insurance, and business license. So we say that we pay $1,200 for business license, divide by 12, $1,200 divided by 12 is $100 per month. It's $100 per month. So we say business license, $100 debit, because that's the portion that we expense in August. We don't expend the $1,200, we spend just $112, which is $100, and there is going to be we are going to just hit the account prepay expenses, because we need to reduce that amount. Remember, originally we put the $1,200 in prepaid expenses. Now we have to expense $100, so that means our balance for this payment license is going to be $1,100 from now on after we do this journal entry. So $100. Okay. In the same way, we pay liability insurance $600. So what means is, if we spend 1 month, is $600 divided by 12 is equal $50. So we are going to say liability insurance $50 here. We are going to say prepaid expenses. We are going to write the prepaid expenses $50 as well. Well, this is the end of our exercise here. And again, just to recap a few things. So remember, journal entries is based on T account. You see the T here, I just highlighted with red. The T account has the left side is debit, credit side, left side is debit, right side is credit. Okay. Also, that in any journal entry that you do, the totals should be equal. Total debits should be equal total credits. If that's right, so your transactions are on balance. So you don't have to worry about that something is out of balance. But if it is, let's say that by accident, let me simplify this one here. Okay, I'm going to do some example here. Let's say that you do this one. So you say, oops, I'm out of balance. So you have to calculate what is your balance. And here it's going to be easy because I just make a mistake by myself. But the discrepancy say that it's $100. So this is one thing that you have to learn. If you have $100, it could be because you just missed $100, or it could be because you put in the wrong size, the half of that one. So if you do that one, this is something that we're learning with the time. So you say that this is equal, this one divided by 2. So you can just look, depending what was the reason. So but in this case, we know this $50. So you have to check all the transactions that have $50. Here is going to be easy because I just did it on purpose, right? So I know that it's $50 as soon as I just remove the $50 from my mistake. So I just get zero balance, so everything is on balance. But let's say that I'm going to work with this again. You just forgot to type the other side for the card, the journal entry. So at this point, you don't have to divide by 2, but you have $50 discrepancy, so it's a full number. Anyway, since you don't know exactly what happened, I always recommend that you divide by 2, just in case. This one divided by 2. So there is two options. One, like the $50 you just missed that one, that entry, or the second one is that you put the 25 in a wrong column. So when you do that, your numbers duplicate. And that's part of the math. That's something that we're learning in math at some point. But anyway, I just want to give you these tips how to find mistakes. So now we know that we just missed something here, $50, so we are on balance. So with these things, we already complete the exercise in terms of journal entries. Well, we are done with exercise. So I hope you guys learning and understand. But if you have questions, don't hesitate just to subscribe and just put the question there. And I'm going to be glad to answer every single question. And if you found this course and exercise has been helpful, consider sharing it with others who want to learn in the basic accounting. I really appreciate it. You just share with this or share these videos or this course with other people that are interested in accounting. Don't forget to subscribe so you can get access to practice exercise and never miss a new video. In my next video, I'm going to learn, or we are going to learn how to create the financial report like a trial balance, and the financial statement like a balance sheet and income statement, also called profit and loss. I'm going to use the same data that we already created through the journal entries to do these reports. So don't miss any of these or the next video. With that one, I'm going to complete the accounting cycle. Thanks for your support and for sharing this with others. See you next time.